Howdy, Jacob here. Today we're looking at Portland General Electric Company, ticker symbol POR. It's in the electric utilities industry, current yield of 4.5% dividend yield. Their market cap is 4.4 billion with an enterprise value of 8.15 billion, so a good amount of net debt. Growth for the company has not been much, but looks like it's gone up relative with inflation, 1.8 billion in 2013 to 2.6 billion in 2022. Let's look at the balance sheet for that debt. It's 165 million cash and cash equivalents on hand with 3.4 billion dollars, over half of what they had 10 years ago of 1.5 billion in 2012. Let's see what that is in relation to cash flow. And the last 4 years, they have not produced positive free cash flow. Ugh, okay. So it's going to be a quick video again because this company doesn't produce cash flow, and we've gotten through enough videos where we know that dividends are paid out through their cash flow. And so if you don't have free cash flow to pay for your dividend, you either have to issue stock or issue debt. And we can see here that outside of 2015, every single year of the last 10 years, they've issued debt. And it looks to be in the relation between their negative free cash flow and the dividend they pay out is essentially the debt that they issue. So there's going to become a point where a lender is going to want to get this money back, and this company is going to have to sell off assets, which will then slow their growth and everything because their current assets or their liquid assets are very little in comparison to their long-term debt. And so I think we can start making some assumptions here. First things first, they can't afford the dividend. So, I'm just coming up with a number, whatever. Let's say they divide it by 5, cut it by 80%. Growth here, probably 3%. Relative with inflation, looks pretty similar. Margins, maybe 8%. And then, we can just say 3%, but they haven't had 3% since 20. Their 3% margin was back in 2017, pretty much. So that's something you really want to see. And then that gets us to a stock price that needs to fall 73% before you get a 15% return, given these assumptions. Again, for me with these types of companies, I just like cash flow. That's how I know the cash flow is the lifeblood of a business. The present value of future cash flow gives you the value of the business. And to me, a company like this whose capital expenditures go up due to their revenue growing up and their cash flow operations does not grow as much as the capital expenditures increases, you just see negative cash flow. And I can't invest in a business that I don't believe in, and I truly believe that the value of a business is based on the present value of future cash flows, and this just doesn't produce that. And so I'll let everyone else who understands this business better or cares more about earnings, SEC filings, or GAAP accounting rules, all that over true lifeblood cash flow. So another short video today, but I hope it is just to show you don't need to look too much at a business if you don't understand it and you don't believe in necessarily the numbers that are shown. And too many other people are going to want this stock over me, given the fact that they have negative 5-year average free cash flow. So I'm not going to go into further detail. Thank you, and have a great rest of your day.